SoFi Technologies is currently trading at $18.29 per share as of Sunday, April 26, 2026. Since the market is closed today, this reflects the final movement from the last trading session on Friday, where the stock saw a slight dip of 0.16%. While a 3-cent move might seem like background noise, it is the calm before a massive storm. This coming Wednesday, April 29th, the company drops its first quarter earnings report, and the stakes have never been higher for SoFi stock. The expectation in the market right now is focused entirely on whether they can maintain their growth streak, but the reality is far more tense. There is a specific shadow hanging over this report that most casual observers are missing, and it has everything to do with a recent short seller report that has put their accounting under a microscope. The narrative you'll hear on most investing sites is that SoFi is a runaway success story, a digital bank that finally figured out how to be profitable. But the deeper reality is a battle over credit quality. Analysts are currently obsessed with the personal loan charge-off rate. While management previously reported this at 2.8%, critics are alleging the real number is significantly higher, claiming the company is offloading bad loans just before they hit the books as losses. If Wednesday's report shows even a slight tick upward in those charge-offs, the expectation of a stable bank-grade balance sheet will collide head-on with a reality that suggests they are still a risky fintech play. This is the curiosity loop driving the massive trading volumes we've seen lately. Institutional activity has been erratic, with big blocks of shares moving as funds hedge against a potential volatility spike. When we look at the broader landscape of online investing, the general belief is that SoFi is the Amazon of finance. People see the 13.7 million members and the record-breaking revenue and assume the upward trajectory is a given. I'm here to challenge that. While the user growth is impressive, the reality of their valuation creates a massive gap. At nearly 27 times forward earnings, SoFi stock is priced for perfection. Compare that to a traditional individual brokerage or even other tech-heavy banks, and you'll see they are carrying a premium that requires them to hit home runs every single quarter. If you look at SoFi Invest alongside competitors like Schwab Intelligent Portfolios or a Fidelity brokerage account, you see a company trying to own every part of your wallet. But trying to be everything to everyone is expensive, and the market is starting to ask when those massive marketing spends will finally start to taper off. The recent movement has been a roller coaster. Just a few months ago, the stock was pushing toward the $30 mark, fueled by the excitement of their national bank charter and new product launches like SoFi USD. Then, the Muddy Waters report hit, and we saw a 50% drawdown from those highs. This created a classic tension point. On one side, you have the permabulls, who see this as a generational opportunity to buy a future giant at a discount. On the other side, you have the skeptics, who see the accounting allegations as a red flag that can't be ignored. If you're looking for investment help, the first thing to realize is that SoFi isn't just a bank. It's a technology company that happens to have a vault. Their technology platform, which powers other fintechs, saw a 23% decrease in enabled accounts recently. That's a reality that directly contradicts the hyper-growth expectation. Institutional investors are watching the Rule of 40 metric here very closely. Last quarter, they hit a score of 68%, which is elite by any standard. This means their combined growth and profit margin is in the top tier of tech companies. But the market is fickle. We've seen Nvidia stock and Apple stock hold their premiums because their cash flow is undeniable. SoFi is still in the proving it stage. When you engage in self-investing or use a platform like the Robinhood app, you're often looking for that next big breakout. SoFi has the ingredients, but the recipe is being questioned. The company recently expanded its loan platform with $3.6 billion in new commitments, which shows that big players still trust their underwriting, yet the stock price hasn't fully reflected that vote of confidence. Comment below how many shares of SoFi Technologies you currently hold, and if you plan to buy more before the earnings call this Wednesday. To understand why the stock moves the way it does, you have to look at the business model. SoFi operates 3 main pillars: lending, financial services, and the technology platform. The lending side, student loans, personal loans, and mortgages, is the old-school engine. It generates the cash. But the financial services side, which includes the SoFi trading platform and their new crypto offerings, is where the brand loyalty is built. They want you to get your direct deposit there, buy your SoFi ETFs there, and eventually take out a mortgage there. This one-stop shop strategy is supposed to lower customer acquisition cost over time. The expectation is that once you're in the ecosystem, you never leave. The reality is that switching costs in finance are lower than ever. Users can jump to SoFi Active Investing one day and move to Interactive Brokers or Fidelity Investments the next if the fees or the interface are better. The technology segment, powered by Galileo and Technisys, is perhaps the most misunderstood part of the company. It's the Intel inside of fintech. When other companies want to launch a card or a digital wallet, they often use SoFi's infrastructure. This is high-margin recurring revenue. If this segment starts to stagnate, the tech part of the fintech valuation disappears, and the stock starts looking like a boring low-multiple bank. This is why the 2026 guidance is so critical. Management is forecasting $4.66 billion in revenue for the year. That is a massive jump,
and it assumes that the consumer stays strong despite macroeconomic pressures like high interest rates and persistent inflation. Looking at the competitive set, you see a clear divide. You have the legacy players like Fidelity Wealth Management or a Schwab Intelligent Portfolio, which offers stability and massive scale. Then you have the aggressive newcomers like SoFi Stocks and the Robinhood app, which prioritize speed and user experience. SoFi is trying to bridge that gap by offering things like Fidelity IRAs would, but with the flair of a Silicon Valley startup. They've even launched their own stablecoin to facilitate global money transfers, a move that is either brilliant or incredibly risky depending on how the regulators feel this week. This is the kind of bold move that keeps the expectation high, but adds layers of reality in the form of regulatory scrutiny. As we look toward the future, the catalysts are clear. If SoFi can prove the short sellers wrong on Wednesday by showing pristine credit quality, we could see a massive short squeeze. There is a lot of betting against this stock right now, and a clean report would force those bettors to buy back shares, sending the price upward. On the flip side, the risks are just as sharp. The fintech sector has been punished recently as investors shift toward value over growth. If SoFi's margins don't expand as promised, the stock could easily test its 52-week lows again. They are also heavily exposed to the student loan market. While that was a headwind during the payment pause, it's now a tailwind as people refinance, but any changes in government policy could flip that script overnight. The tension between the market's narrative and the company's actual performance is where the opportunity lies. Most people are either 100% in or 100% out on this stock. The reality is likely somewhere in the middle. It's a company with a world-class brand and a brilliant CEO in Anthony Noto, but it's also a company that is navigating a treacherous transition from a scrappy startup to a regulated banking giant. When you're looking for investment help or exploring investing sites, you have to separate the noise of the daily price swings from the signal of the long-term fundamentals. In the final analysis, SoFi is a story of transition. We started with the expectation of a simple fintech flyer, but the reality is a complex multi-billion-dollar financial institution that is currently fighting for its reputation. The contrast between their record-breaking member growth and the accounting allegations has created a vacuum that will be filled with information this Wednesday. Whether you use the SoFi robo-advisor or prefer a more hands-on approach with a Fidelity trading platform, the lessons here are the same. Price is what you pay, but value is what you get. And right now, the market is having a very hard time deciding what SoFi is actually worth. To wrap this up, the central insight is this. SoFi has successfully built a massive one-stop shop that consumers love, but they haven't yet convinced the big money on Wall Street that their books are as clean as their app's interface. The expectation is a major earnings beat, but the reality will be found in the fine print of the charge-off rates and the technology platform's growth. We've seen how Tesla stock or Nvidia stock can defy gravity for years based on narrative alone, but eventually the numbers have to do the talking. For SoFi, that conversation starts in just a few days. Keep your eyes on the volume and the institutional flow, because the smart money is already making its move. And to wrap this up, the central insight is this. SoFi has successfully built a massive one-stop shop that consumers love, but they haven't yet convinced the big money on Wall Street that their books are as clean as their app's interface. The expectation is a major earnings beat, but the reality will be found in the fine print of the charge-off rates and the technology platform's growth. We've seen how Tesla stock or Nvidia stock can defy gravity for years based on narrative alone, but eventually the numbers have to do the talking. For SoFi, that conversation starts in just a few days. Keep your eyes on the volume and the institutional flow, because the smart money is already making its move.